Ever wondered about the current state of our economy, or how the S&P 500 is performing? Let's dive into the recent Consumer Price Index inflation data for January and see how it has impacted the S&P 500 and the wider market. This January, core inflation ran hotter than anticipated, with service prices rising at the fastest pace since September of 2022. This increase in inflation was a bit of a jolt for the S&P 500, which opened sharply lower following the data release. The overall consumer price index rose by 0.3% on the month, surpassing the forecasts of a 0.2% rise. The 12-month CPI inflation rate dropped slightly to 3.1% from 3.4% in December, exceeding the 3% forecasts. When we strip out the volatile food and energy prices to focus on the core CPI, we see that it rose by 0.4% versus December levels, which was higher than the 0.3% estimates. The annual core CPI inflation rate unexpectedly held at 3.9%, which was above the forecast of 3.7%. In response to this data, the markets came close to pricing away 1/4-point Federal Reserve rate cut. This goes to show how intimately connected the CPI data, the stock market, and the Federal Reserve's decisions are. On the other hand, core goods prices fell 0.3% on the month, marking the biggest drop since July. However, core service prices rose by 0.7%. This included a 2.4% jump in hotel and motel rates and a 1% climb in transportation service prices. It's clear that the CPI inflation data can have significant ripple effects across the economy and the stock market. So that's a snapshot of how the recent CPI inflation data has jolted the S&P 500 and impacted the markets. But what does all this talk about the CPI inflation data mean? It's time to demystify the Consumer Price Index, or CPI, and its effects. Firstly, let's break down the CPI inflation report. The overall Consumer Price Index is a measure of the average change in prices paid by urban consumers for a basket of goods and services, such as food, clothing, transportation, and medical care. It rose by 0.3% in a month, more than the expected 0.2%. The 12-month CPI inflation rate, which shows how much prices have increased over the past year, eased from 3.4% in December to 3.1%. This was above the expected 3%. The core CPI is a similar measure, but it excludes volatile items like food and energy prices. The core CPI rose by 0.4% compared to the previous month, exceeding estimates of 0.3%. The annual core CPI inflation rate held at 3.9%, higher than the forecasted 3.7%. Now, what impacted these changes in prices? Housing was a major contributor, with shelter costs up 0.6%, including a 2.4% surge in motel and hotel rates. Transportation services prices climbed 1%, while prices for food away from home rose 0.5%, the biggest rise since May. Prices for inpatient and outpatient hospital services jumped 1.8%, the largest monthly increase since October 2015. You might also come across the term PCE, or Personal Consumption Expenditures Price Index. This is the Fed's primary inflation gauge, and it showed much tamer price pressures than the core CPI over the second half of 2023, 1.9% versus 3.3% at an annual rate. The key difference between the two is that the CPI data is based on out-of-pocket spending, while the PCE data includes employer and government reimbursements to medical providers. So, now you know how the CPI inflation data works and why it's crucial to monitor it. It's a key economic indicator that can affect everything from the prices you pay at the grocery store to the interest rates on your loans. Understanding it can give you a clearer picture of the economic landscape. Now, how does CPI inflation data influence the Federal Reserve's decisions on rate cuts? This question brings us to the crux of our discussion today. Understanding how the markets react to inflation data, particularly in terms of Federal Reserve rate cut odds, can give us valuable insights into the broader economic picture. After the release of the recent CPI inflation data, the markets began to adjust their expectations for rate cuts. Initially, the markets were pricing in a modest 6.5% chance of a Federal Reserve rate cut on March 20th. This may seem low, but remember, The markets are always forward-looking, constantly adjusting odds based on new information. As we move further into the year, the odds of a rate cut increase. By May 1st, the odds rose to 37%. By June 12th, the odds stood at a significant 78%, down from 92% just the prior Monday. This shift in odds reflects the market's reaction to the hotter-than-expected inflation data. So what does this mean for the economy? Well, rate cuts generally stimulate economic activity by making borrowing cheaper. This can boost consumer spending and investment, which in turn can stimulate economic growth. However, rate cuts can also lead to higher inflation. It's a delicate balancing act for the Federal Reserve, and the CPI inflation data is one of the key indicators they use to guide their decisions. Now, let's turn to the S&P 500, a broad index of US stocks and a key barometer of the health of our economy. Following the release of the CPI inflation data, the S&P 500 fell 1.4%. This might not seem like a lot, but in the world of finance, these small shifts can have big implications. Why did the S&P 500 fall? In part, because higher inflation can lead to higher interest rates, which can make borrowing more expensive for companies. This can squeeze profits and lead to lower stock prices. But the story is more complex than that, with many factors at play in the market's reaction. Understanding the relationship between CPI inflation data, Fed rate cut odds, and the S&P 500 is vital in predicting potential shifts in our economy. This understanding can help us anticipate market trends and make informed financial decisions, whether we're economists, investors, or just interested observers. So, what are the key takeaways from our discussion today? We've delved into the world of Consumer Price Index, or CPI, and its impact on the S&P 500 and the markets. January's hotter-than-expected core inflation, with service prices at their fastest pace since September 2022, led to a sharp drop in the S&P 500. Interestingly, while the overall CPI rose by 0.3%, the core CPI, which excludes volatile food and energy prices, saw a rise of 0.4%. This unexpected hold at 3.9% is significantly above the forecast of 3.7%. We've also looked into the Fed rate cut odds in the wake of this data. Despite the market pricing in low odds of a rate cut by March, the odds stand at a notable 78% by June. Lastly, we've explored the S&P 500's reaction to the CPI inflation data. Despite a minor dip on Monday, the index saw a significant 1.4% fall on Tuesday morning. And with that, we wrap up our discussion on how CPI inflation data can jolt the S&P 500 and influence Fed rate cut odds. Stay tuned for more insightful discussions on the economy and the markets.